Hi, everyone, and welcome back to Positive Investment Symposium. Positive Investment Imperial is a group of students at Imperial College Business School aiming to educate and galvanize actors towards positive investment practices. This symposium is a culmination of our work this year on our research, education, and endowment, and we're very excited to have you here with us today. Thanks for joining our Where's Impact Investing in 2021 panel. I'm Beril Dora, co-VC endowments for Positive Investment Imperial with Luke and MSc candidate at Imperial Business School. I'm also interning at an impact fund called Oryx Impact, which invests in VCs and PEs in Africa to support and develop sustainable local economies, gender equality, and climate change mitigation and adaptation, along with improving impact measurement and practices in the continent. Impact investing field has been growing extensively in the past few years. There's some confusion as to what impact investing is, what it's not, and how it differs from ESG investing, how widespread it is, what are some new trends within impact investing, and how it's expected to evolve. Firstly, to make sure everyone has a good understanding of what impact investment means, let's define it. The Global Impact Investing Network defines impact investing as investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. Impact investments can be made in both emerging and developed markets and target a range of returns from below market to market rate, depending on investors' strategic goals. Impact investing is a tool to have your capital make a positive impact on the real economy instead of protecting your capital from social, environmental, and governance factors happening in the real economy. Impact investing is certainly not one thing, and our fantastic group of speakers today are from different areas within the field who will tell us what their organizations do, what their role is, how the landscape is changing in 2021, what are some trends, and how do they further see impact investing evolve. So first up, we have our first speaker, Nicholas Andreou, who's an investment manager at Big Society Capital. Nicholas started out his career in academia, first as a PhD candidate and then a research associate at the University of Nottingham. His work focused on Sustainable Development Goal 8, which is decent work. He worked alongside stakeholders including the European Commission, the World Health Organization, and the International Labour Organization. Nicholas jumped into the entrepreneurial ecosystem, joining Balloon Ventures, a startup aiming to improve livelihoods of informal entrepreneurs across East Africa through training and financing. While at Balloon Ventures, Nicholas helped to grow the company revenue threefold by developing corporate partnerships. Upon completing his MBA at Oxford, Nicholas joined Big Society Capital as an investment manager. Nicholas is involved in deals across debt and equity projects. He also acts as an advisor to Big Society Capital's venture portfolio on impact strategy and delivery. I'll leave the stage to Nicholas now.
Great, thanks very much for the intro. I'm just gonna attempt to share my screen. There we go, hopefully you guys can see that. Great, so yeah, I work at BSC, Big Society Capital. We're a fund-of-funds impact investor in the UK, which means we invest into funds and then they invest into charities, social enterprises, real estate projects, renewables, and venture as well, which is a bit of the portfolio that I am most closely associated. And impact investing has been growing pretty steadily. I think according to GIN, it's something like a 17% annual growth over the last 5 years, something like that, which is great, but we obviously want to see that grow even faster. And so the question is, how do we do that? And if you think about what drives mainstream investors, it's clearly about returns. And so if you can make impact a part of an investment strategy that generates or enhances returns, then we are more likely to see mainstream capital flow into impact investing. So that's really the challenge that we at BSC are trying to do. How can we create this narrative which makes impact a source of value rather than thinking about it in terms of trade-offs or discounts to returns or increased risk and stuff like that. And just to be clear, this isn't possible in all asset classes, in all business models, but we do think it's clear in some, and particularly in the venture context, which is where I work. So we call this the shared value hypothesis. So thinking about impact and embedding impact in your startup both enables you to grow and deliver returns for investors, but also allows you to generate impact. And I thought it would just be useful to give you guys a flavor of how we're thinking about this, because I think this is increasingly the lens with which impact investors and investors will be thinking about impact over time. So we think there are 4 buckets to this sort of shared value thesis. And the idea here is that impact drives value through customers, talent, risk, and capital. I'm just going to try and break these down with some examples. So in the customer bucket, there's sort of really simple arguments, like the idea that 2/3, I think it is, of consumers consider impacty type of information in their purchasing decisions. And so obviously, if you are an impact startup, if you have that as part of your narrative, then people are more likely to buy from you. Not only do customers think about that when choosing whether to buy or not, but also in terms of how much they're willing to pay. So there's a lot of data showing that there's a premium associated with that as well. So what we're saying is you're more likely to acquire high-value customers if you have impact embedded into your business model. That's like a superficial level of argument. It gets much deeper in terms of impact doing interesting things when we think about unit economics or market size and stuff like that. So let me give you an example from microfinance, which is about 4 or 5 decades old now. So we have a lot of data on that particular area of the market. So microfinance started as this idea of how can we give loans to people living on very, very low incomes, like $1, $1.50 a day, that kind of thing, which seems crazy when you think about it. The cost to acquire those customers, given they're in sort of rural settings, might not be home a lot, et cetera, is very high. The cost to serve those customers is also equally high. You know, if you think about like a credit check, there are often no tech platforms that let you do this. They often don't have good records for customers of the transactions. And so how do you build a credit score? It's really, really hard and expensive to do that. That's on the cost side. On the value side, we also don't see a very compelling proposition because the loan's a small amount and the interest, while it might be high compared to what we might pay, it doesn't seem profitable relative to the risks. And in fact, the losses associated with that segment of the market could make this seem even more unattractive. And then you have a group led by Mohammed Yunus that really wanted to solve this problem, wanted to make finance accessible to everyone at the bottom of the pyramid. And they came up with many innovations, but the main one being around group-based lending. So you form a member of a group, and that group guarantees your loan to a microfinance provider. So what's happening here? The cost to acquire those customers has suddenly dropped quite a lot. Because if you're acquiring one customer, you're now acquiring a group of people that you could potentially sell a loan to. The cost to serve that group or that customer has reduced because the group tends to be self-regulatory. So you need to be far less involved. And in terms of losses, those come down quite a lot because the group is guaranteeing the loan. And so this is a really great example of someone who's innovating with an impact lens. And what that's done is that's created a set of unit economics that make a customer group profitable to serve, whereas before they weren't profitable to serve. So the microfinance industry globally today is, I think, something like $120 billion, 150 million customers. And that's really huge when you think about the underlying proposition there. So impact as a sort of a lens to think about how we create a business model is creating real value here in terms of a market. The investors who went into early microfinance providers did pretty well. So out of India, the first MFIs generated around 10% IRR on those funds. And the second generation of funds that have sort of figured out how to optimize those business models, they're looking at more of a 25% IRR, right? So that, I mean, that's sort of really healthy returns and on par, if not sort of top quartile across Indian VC. So this sort of really demonstrates that impact doesn't have to be a discount of returns if you can figure out the right configuration of business model in order to create both value and impact. And certainly the demand for those kind of products from investors in places like India and Mexico, where microfinance started, is through the roof. So that hypothesis of you prove that this stuff drives value and money flows in, that's really playing out. And we're trying to bring some of that story to more developed market as well. Jumping to the second bucket. So talent is really important to early stage startups. If any of you are sort of involved with startups, you'll know that a key thing about success or failure here is the people who are on the team. In fact, lots of different surveys have people as it's normally the top 3 reasons why a startup fails, because they can't hold on to their best people, or they don't have the right talent in the first place. And what we're seeing is an increasing drive from younger generations to take on jobs that are aligned with sort of deeper values. So according to LinkedIn, 75% of millennials or Gen Zs want purpose to be part of their jobs. But according to Deloitte, only 33% of current employees feel like work enables them to tap into that need. And so there's clearly a pretty big mismatch there. Now, if you're a startup and you can offer a sort of clear sense of purpose, then all of those people whose need is not currently being met, they will be much more interested in joining your startup. And even across our portfolio, we've seen a lot of startups hire from big hitters like Facebook, Uber, Amazon, etc. And a part of that is down to the purpose of some of those organizations and being able to tap into those people's needs. So that's the second bucket. If you kind of have impact embedded in your business model, in your startup, then you're more likely to attract the best talent and therefore less likely to fail as a startup. The third bucket is around risk. So startup investing and the business of starting a startup is very risky. Typically, less than 10% of startups survive, and so mitigating risk is a key challenge here. And again, we think that if you take an impact lens to how you run your startup, you're more likely to mitigate risk. And a good example is in regulatory risk. So if you think about providing people with short-term loans, that's an area that's seen a lot of activity here from the regulators. So you guys might remember a company called Wonga. They made payday loans, but charged incredibly high interest rates to make the business profitable, like in the thousands of APR, if my memory serves. And eventually the regulator came in and said, look, this is crazy. We're going to put a cap on your interest rates. And the business model became unviable and they went into administration. A lot of Wonga's competitors also decided to leave the UK market. Conversely, when you think about some other models like WageStream, which is a company in our portfolio, they've taken a different approach to making capital affordable in a way that is much more, I guess, viable from a borrower's perspective. So they use earned but unpaid wages as a way to advance people cash. Right, so the risk for them is quite low because those wages have already been earned, and therefore they don't. It's not a loan, so they don't charge interest. But essentially, the cost for the person borrowing is far lower. And the regulator is very positive about those sorts of models. They're called sort of salary financing models. So we can see here how having an impact lens means that you are more likely to stay ahead of the regulatory curve and survive as a startup. Linked to that is the fourth bucket around capital. So the idea here is that startups can attract more capital if the other 3 buckets all apply, right? Because all else being equal, an investor would want a startup that can attract and retain customers better, attract and retain talent better, and mitigate risk. And we're beginning to see some evidence of this. So I've got some stats here. So a couple of big IPOs in the US for impact startups. Lemonade, which is an affordable insurance provider, they had a 144% share price uplift on day 1, and Beyond Meat 163% uplift on day 1. Beyond Meat is a sort of alternative protein type startup. So that's showing significant demand from investors for these sort of impact propositions. But what's really interesting is when you compare that to Deliveroo, that just recently IPO'd, they had what was quoted as the worst IPO in the London Stock Exchange's history. So a real contrast there between sort of conventional business models and impact business models in terms of demand from investors. What's even more interesting is why investors chose to avoid the Deliveroo IPO. So this is a quote from M&G, a big investor, and they said that they decided not to invest, this is a quote, largely driven by the company's reliance on gig economy workers in the UK as informal employment contracts potentially fall short in offering the value, job security, and benefit of full employment. Uber is a very topical example of greater legal rights being enforced by the Supreme Court to riders previously categorized as self-employed. And so M&G here is worried about the profitability of this business model. And that's why they decided to avoid it. So we can see there that's a direct link between sort of the risk piece and the capital piece. But in essence, that's kind of what we expect to see. We expect to see these 4 buckets driving value for startups that are choosing to have an impact lens on their business models, and also driving value for the investors who are increasingly choosing to back these types of businesses. And as I said, we're excited about this narrative because this allows more and more capital to begin to flow into the impact investing space. So since we've been talking about these different ideas, big society capital, we've seen something like a 10 or more X increase in the number of funds that come to ask us for capital to deploy through venture investing. And that's over the last sort of 2 or 3 years, which is really a phenomenal, that's the biggest uptick we've had in our venture investing space since we started. So that was just, I just wanted to share with you guys how we're beginning to think about impact. It's no longer a sort of a discount to returns. We're really trying to think about how it drives value. We've made our most recent venture investments with that hypothesis in mind. We're picking our GPs, our general partners, who, people who think like that and who want to deploy capital like that. And we are looking to prove out some of these hypotheses that we have around how impact can be a source of value. And I think that's ultimately where the future of this space is going to be in probably less than 5 to 10 years, but let's call it 5 to 10 years. And so I will leave it there. I'm quite keen to take any questions if we have it at the end. And so I will stop talking and hand back to Beryl. Thanks.
Perfect. Thank you so much. That was very insightful. And we'll do a Q&A at the end with everyone. So our next speaker is Grace Eddy, director at Generation Foundation. Generation Foundation is the philanthropic arm of the sustainable investment firm Generation Investment Management. The foundation's mission is to use philanthropy to help limit global warming to 1.5 degrees Celsius and create the fair economic system required to do so. Prior to joining the foundation, Grace worked for JP Morgan, as well as a number of community development and research organizations where she examined the intersection of environmental impact and social outcomes. Grace has an MSc in Sustainable Development from Edinburgh University and a BA in Philosophy and Political Science from Trinity College Dublin. Grace, you can take over.
Excellent. And I'll try to share my screen as well, so we'll see how that goes. Excellent. I'm hoping everyone can see that and someone will shout at me if they can't. But good. So I'm Grace, and as Beryl mentioned, thank you. I'm the director of the Generation Foundation, and we're probably a bit of an oddball in this discussion because foundations have typically, they are the leaders and at the vanguard of impact investing. But at the Generation Foundation, we leave the investing to our donor, the organization who funds all of our work, which is Generation Investment Management. And our focus is actually on trying to shift the economy to be more sustainable and drive more sustainable and impact investing. And so I'll focus on a few things. I'll talk you through a little bit about us as an organization and our history, our view on where impact investing is at the moment, and a few of the things that we're doing to try to shift the landscape and try to really push to limit warming to 1.5 degrees, create a fair economy using the investment system. So on who we are, the foundation, as I mentioned, is associated with Generation Investment Management. We were founded at the same time in 2004 by Al Gore and David Blood, who I believe spoke earlier today. And the foundation was established at the same time because Generation IM has always been a sustainable investor and focused on only investing sustainably, but was never planning to kind of take over the world. They wanted to demonstrate that this works, prove the business case through their investment. And then really the foundation's role was to spread that practice more broadly and introduce this concept to a wider variety of people. So I'll talk you through a bit of the history because obviously the landscape has changed quite significantly, even though it was only 2004. So in the early days, sustainable investment, was a relatively new concept on the scene. And so most of what the foundation did was write papers introducing this idea and kind of saying, this is what sustainable investment is, this new idea that might work. And as the years progressed, thankfully, sustainable investment really took hold. And so our focus shifted to a mix of, let's make the business case. So how and why, and then also trying to fund some of the, I guess, the nuts and bolts and infrastructure of sustainable investment. So these are things like SASB and the Impact Management Project. So we did a mix of research, actionable research, and funding organizations that really kind of supported the landscape. And coming into 2020, we were at the stage where we reset our strategy every kind of 3 to 5 years and recognized that we were not on track to where we thought we should be by 2020. And that, if we took a good hard look at ourselves, we're not on track to limit warming to 1.5 degrees. We're not on track to achieve the SDGs. And though we and the community of wonderful organizations had achieved some really important incremental shifts, it was not going to be enough to get us to where we needed to be. And so we really focused ourselves on that 2030 goal and said, what would we need to do to be able to look back in 10 years' time and say we did absolutely everything that we could. We threw all of our networks and expertise and ingenuity at this. And so that's what we are trying our best to do and get started on. And so that leads me to our strategy and kind of where we ended up, or at least where we're starting. So I'll quickly run over this, but focus on investor climate action because I think that's most relevant for this. But the two overarching goals that we focus on in the foundation in our grant making are climate action and fairness. We see them as two parts of the same whole. We don't think you can achieve one without the other. And within those, we have 4 strategic priorities, and then within those quite specific avenues that we're looking at. But we are trying to find the gaps, the areas where generations' expertise and networks and skills can be most applicable and where we can drive some really important changes over this time. So I'll look at investor climate action first. And this is really what we are trying to do, is move from, a world where there's small pockets of impact investing to really where finance plays a really key role in driving the transition to net zero. Because we see, all of the G7 countries have now set net zero targets. We're seeing huge ambition in the lead up to COP. We're seeing, a recognition, I think, post-COVID that actually, listening to scientists early and taking action early is the right approach. And so we're starting to see all sectors of society and economy moving with haste towards real action on net zero, but we won't do that if the finance community is not really aligned and really on board. And in our view, we're not quite there yet. And so our focus is on getting that right. So I just want to talk about the spectrum of capital. I like this from Bridges. I find it quite helpful. And Beryl, your explanation was excellent of what the different types of capital mean, but I think we all use these terms a little bit differently. I know I certainly can use sustainable and impact investing interchangeably, and I find this kind of a useful tool. So just on the left-hand side, traditional, what we would think of as kind of the broad range of investing that has no consideration for environmental, social, governance risks or opportunities, which we hope is now in the minority. And then responsible and sustainable investing as the next rung there, and impact investing, where it covers a broad range from finance first to maybe concessionary capital, but all with the goal to have a positive impact. And then to philanthropy, where you may not be investing at all, which is most of what we do. And our previous work in the foundation, I mentioned those incremental shifts. We looked a lot at fiduciary duty and getting traditional capital to align with more responsible and sustainable approaches. So requiring the consideration of ESG in an investment process, because environmental, social, and governance risks are still material risks. And so all investors have a responsibility to incorporate those. And we're really proud of the work that we've done there and the work that the community has done to get that really on the agenda, but we still don't think that's going to be enough. And so now our focus is shifting that traditional, responsible, sustainable capital into impact. And that might seem like kind of a really ambitious target to set ourselves, to have mainstream capital shift into this space. But actually, if you are defining impact investing as impact, having an impact goal and seeking to have an impact on the world, not just thinking about the impact of sustainability factors on your portfolio, then things like BlackRock and Vanguard setting net zero targets start to look a lot like impact investing. Now we'll see how that shakes out in reality, but it doesn't seem so crazy to start to shift the entirety of the system into line with impact targets, because if we don't, it's going to be very difficult to achieve the SDGs. And so I'll quickly run through a few of the ways that we in the foundation, the initiatives we're supporting to try to drive this change. So this is how we look at all of our strategic priorities. So at the systems, industry, and grassroots level. And at the systems level, we are working with UNEP-FI and PRI on a project called the Legal Framework for Impact. Now, I won't go into too much detail on this, but essentially, we're trying to identify whether the law requires or permits mainstream investors to take into account impact considerations in their investment decision-making. And that's separate and distinct from ESG, where it's based on material risks, but even if they're not material or provably material, can investors take these into account, and are they required to? And that work will look at that and then also move on to take action so that it is required, or we hope we can take action so that it's required of mainstream investors around the world. The industry side, even if we get all the rules in place, we still need to have the investable universe available for investors to really drive the change they need to be able to have investable products. And so we're working with the Center for Climate Aligned Finance, which works with financiers and highest emitting sectors to design decarbonization pathways and agree those and commit to those within a short-term timeframe with a 1.5 degree pathway and a 2030 midterm goal. And finally, at the grassroots level, we're working with organizations like Share Action and 350 Africa to make sure that these solutions aren't just kind of designed in the ether and disconnected from real people who are the bulk of the people whose assets are invested through pensions, through development finance institutions and others. And so all of that work we are trying to link together, trying to push quickly and really focused on urgency. And then I guess the kind of final point I want to end on is just the fact that organizations like, foundations, places like Big Society Capital are really at the front of this and really have been proving the case that impact investing works. And what we really want to see is the entire financial market to catch up quickly and to take action now. So I'll pass back to you, Beryl. Thank you.
Thank you so much, Grace. And last but not least, we have Tom McGillycuddy, the co-founder of tickr. tickr is a London and Liverpool-based impact investing startup designed to empower a previously excluded generation to invest for the first time using the feel-good factor of positive impact. Prior to tickr, Tom spent 8 years in investment management and investment banking, most recently as part of the founding team of Wellington Management's $1 billion Global Impact Fund, and he is also a CFA charter holder. Tom, please take over.
Thank you. I'll just try and share my screen. You can see that? Cool.
Yes.
Great. Well, thanks for inviting me to speak. I really appreciate it. I have 3 dogs sat around my feet, so if there's random barking that starts during this, that's why, and I'll try and move them on. And I also have a habit of going really fast through slide decks, so I'm going to try and pace myself and slow down. So I want to talk about the rise of the retail impact investor. And I think this trend has firmly started in the past 12 months. Before I do that, I'll give a little bit more background on who I am, what tickr is, what we're trying to achieve, who our customers are, and then the trends that we're seeing coming through in retail impact investing. So I started my career at Barclays in the investment bank, and I got disillusioned with that after about 2 hours of being there. But it took me a few years to pluck up the courage to leave. This is like 2012, I started to desire having an impact specifically related to the climate in my work. And obviously at that time in that industry, absolutely nobody else cared about that. So I felt completely at odds with the industry and decided to leave the industry and pursue a career in something completely different. But joined Wellington Management as a kind of stopgap. And there I got introduced to a guy called Eric Rice, who's now the impact team at BlackRock, the head of the impact team at BlackRock. And he told me about this idea he was working on for a fund with a dual purpose: to beat the market every year, the global stock market, but only by investing in companies whose business models were trying to address world problems. That was before I knew really what impact investing was, but it was his expression of it in publicly listed markets. And I convinced him to let me work on the idea in my spare time initially, and then after about 6 months, 8 months, it became my day job. And by the end, there was 4 of us managing $1 billion, investing in some amazing companies around the world, companies whose stories you could tell to your family and friends, and they get it. They get why they're a good thing for the world. And during that process, myself and Matt, who I founded tickr with, we started to become more enthusiastic about the idea of bringing what we were doing to everyday investors, more so to people that had never invested before. When Matt and I started our careers, we actually both met on the first day of the Barclays graduate scheme. And we both come from working class backgrounds in Northern England. None of our family members have been to university, worked in finance. And we were definitely the idiots in the room on that Barclays graduate scheme. There was nobody else who looked and sounded like us, and we didn't have a glitzy education or background. And I couldn't even work out a percentage on my calculator on the first day. It's a miracle how I actually got onto that graduate scheme. But then after a few weeks, I realized that the industry has been designed to feel complex and keep people out and kind of rob a future from the people that I grew up with. So financial inclusion became a personal passion of mine and Matt's. And as we started working in impact investing and around that sector, the more we realized that impact investing could be the tool to address financial inclusion, because you could bring people to the table to invest for the first time because they understand it and they're connected with it, they're connected with the narrative, it feels good to them. And in doing that, you can get them to adopt the sustainable long-term investment behaviors that they need to build wealth for themselves. So those 2 elements are why we founded tickr in 2018 and left our jobs. We became more enthusiastic about investing money for individuals and people that had never done it before. So tickr, briefly, what it is today is primarily an impact investment app. We have themes that our customers can choose from to invest in people, planet, and people and planet. In the background, there are hundreds of listed businesses around the world that are linked to those themes. And in the app, our customers can learn about the themes, learn about the companies, learn about the impact their investments are having. And we've just started to bring out 2 additional elements of the product, which is more where we're moving in the future. When you sign up to tickr, customers link their bank account through open banking, and we started to do a couple of additional things. The first is we calculate your carbon footprint based on your bank account. We will calculate your water and plastic footprint later this year too. So we give you an idea of your kind of personal footprint on the world. And then we offer you places to improve that footprint, i.e. we have a partnership with Bulb Energy. So when we see someone's energy bill come out, we recommend them Bulb. A customer at tickr gets a month free and a credit in the tickr account for switching. And then they have more impact through their expenditure. And then whatever's left of their footprint, we offset it for them using a monthly subscription that goes towards UN Gold Standard carbon credits projects. And then we retire those credits from the market. So the idea is that you invest in the solutions to the problems that you care about, which is good for you and good for everyone else. You make your expenditure as impactful as it possibly can be, and then you offset the rest. And the idea is that we grow to become the most convenient place to positively impact the world through your finances, investing just being one of the ways in which we express that. And our customers, who they are today, so we have about 150,000 customers in the UK. The average age is 31 years old, gender neutral as a customer base. And I think the most important stat on there is 90% are first-time investors that have never done it before. And they're investing £200 a month. So we've got a demographic, a generation of people that have never done this, would have ordinarily never done it. Through that data and other data that we have, and meeting and speaking to our customers, They basically have a bank account, and then they have us. We are the savings and investment vehicle that they use for their future. And that's a little bit of the focus of what I want to come on to next, which is, I think there are 4 huge trends happening now that are spearheading the growth in retail impact investment, and I think ultimately will transform the industry. The first 2 on there, I think, are well known. The wealth transfer, people have been talking about this generational wealth transfer for about 1 million years now, but I think it's slowly happening, and we see it with our customers. It's definitely starting to begin. And then the second being these huge environmental and social issues that all of our customer base and all of our generation and beyond really care about and want to kind of solve in any way they can. When we speak to our customers, they're changing what they eat, the clothes they buy, where they travel when they can travel, and they're changing what they do with their money. They're doing everything they possibly can to have an impact on these issues. And then I think for the first time ever in Europe, there is now a pronounced desire to invest amongst our generation, which I'll come on to in a little bit more detail next. And the fourth one is the desire to have impact through your finances. And I think those 4 together, at the intersection of those 4, in a Venn diagram, if you can imagine it, is impact investing, retail impact investing. I think those trends mean that this way of investing amongst that generation beyond will accelerate. So the desire to invest, you start to see now where the slides become designed by me, because I've run out of visual ideas. I just probably put words on the slides. So the desire to invest, I think for the first time ever in Europe, 3 in 4 people under the age of 35 are considering investing for the first time. I think 2 years ago when we started working on this, we went live with tickr. That was not the case at all. We were having to sell to venture capital investors and to anybody that we could raise money from, that we would kind of start that trend in Europe. And obviously it's not us that have done it, but it's something that's brand new. I think something that's 12 months old, but even in the first quarter this year, it's really, really ramped up. I think that's a structural shift. I don't think that's going anywhere. I think we're very much at day 1 of that. And some of our research of our own customer base, 35% of our customers cite financial return as the primary driving reason to invest with tickr. I think that's super interesting, because obviously we're an impact investment app, but I think that 35% will grow over time as we scale our customer base. I think Nicholas kind of touched on this a little bit, but in order for us to scale as a business, and the reasons why we have to scale are, on the way in, we're solving a financial inclusion issue, which is the vast majority of our customers have never invested before. And on the other side, we're kind of changing the way that generation see investing. So the default option for that generation becomes impact investing. So what we have to aspire to be, I think, is just the best investment option for our generation and its impact. That's the way we get scale. That's the way we get growth. We just create the best option in its category, and it's embedded with this impact factor, which drives referrals, engagement, retention. It's similar in my mind to how Tesla have built their cars, in the sense that what they've built is the best car for its category, and it's electric. So you get a lot of people that buy Teslas just because it's the best car in the category, and they tell their friends and post pictures about it because it has that smugness factor of impact. I think we have to learn something from that product management and product creation journey that Tesla went on. And one of the things that I started to think about in Q1 this year was there was a huge desire to invest that came about, and you saw that manifest itself in some ways that I don't ethically kind of agree with, which is the short-term trading culture, which started in the past 12 months, but especially in Q1. But what if we could harness all that energy and all that desire to invest? Because I think that's the positive coming from it, is that there's a lot of people engaged in what they think is investing now than that weren't in the past. What if we could harness all that energy in a different way? What if we could harness it for impact? So the fourth kind of mega trend was that desire to have impact. So 45% of tickr customers are impact first when it comes to investing, which I suppose it isn't as surprising because our early adopters being very kind of impact minded. 70% of them prefer to spend their money with ethical brands. That's our own research as well. Again, they're doing everything they can to change their expenditure, change their habits. So how could these two factors kind of combine to change an industry? And I think what we as an industry, we've written some articles about this, need to do is use the gamification of trading apps and those short-term attention grabbing apps in a non-nefarious way to kind of gamify and make impact more interesting, because that's what we're trying to do. We're trying to make it seem fun and engaging to have a positive impact on the world. And I think if we can do that, you can harness that desire to invest as a trend, and you can harness the desire to have an impact as a trend, and you can create impact investing as the default option for an entire generation of people. So we can go from 150,000 to 1.5 million, 50 million people invest in this way, and they will have never done anything else. They will never have known any other kind of investing. And to those people, impact investing just becomes investing. It's just the way they've always done it. And I think that's the way we can use the current huge trends that happen in the investment world and the impact world, combine them, and create a business which uses gamification in a positive way to drive more impact. And that is everything I wanted to talk about.
Perfect. Thank you so much. I think it's quite remarkable what you're doing, bringing impact investing to retail customers.
Thank you.
Now we can move on to our Q&A session. So just as a reminder to the audience, we can type up your questions in the Q&A box on the bottom right. And yes, we'll start with the first question. I think this one's for Nicholas. It says, I'm really curious which organization in India regarding microfinance was the data from?
Hi, yeah, it was from Lot Capital, a VC that invests in a few different themes, one of them being financial inclusion, I think healthcare, and oh, here we go, yeah, financial inclusion, healthcare, agriculture, and livelihoods, that's what they focus on. So they went into a bunch of MFIs, and this was all from like their blog and stuff like that, so I assume that they're being honest about the returns.
Thank you. The second question is, a lot of the discussions seem to be focused from a global north perspective. Do the panelists see sustainable and impact investing coming up and being taken seriously in the global south? I live in a developing country and personally haven't been seeing this trend lately. I appreciate that. I think Big Society Capital and tickr currently are mainly, their activities are in the UK, but it would be great to get any insight if you've thought about it.
Yeah, I mean, no major insight. We're in the UK only at the moment. That's an intentional thing until we kind of scale a little bit. But we do get a lot of inquiries, reverse inquiries from geographies all around the world. Basically, a lot of them are in Europe and some other countries that you might expect. We don't get many from places in the global south, but that doesn't mean there's not demand there. We just never looked at it. We've never researched it because we'll probably go somewhere a little bit close to home as a test case for international expansion when we do it. But our business will be a global business. So I think the demand, my guess is it will be there. We just need to go there and tackle it when it feels right to us. But it's no other reason beyond a scale and regulatory reason, basically, for us.
I can chime in I'm not sure that we have the deepest experience, but from the foundation perspective anyway, generation investment management is largely across Europe, the US, and Asia. And our grant making has typically focused around the areas where we have most knowledge and expertise and networks. But over the last year, or maybe 2 years, we've started to kind of expand our horizon. So, you might have seen on the last slide there, we mentioned 350 Africa, who we're 350.org is a global campaigning organization, but working with 350 Africa to support largely climate NGOs across 4 different countries in Africa to understand and engage with financial institutions in their own contexts, and trying to drive a more kind of just transition and work with development finance institutions and with particularly major oil and gas projects. The other, it is a very early stage. I think we will do a lot more of that. We've just hired someone who is from Ecuador because we want to make sure that we're not kind of wandering into to try to build solutions in places that we don't know. I think it's slightly different if you're a grant maker. It's important to really understand the context and have local experience and knowledge. We have done some work on Brazil. So through our legal framework for impact project, we're trying to look at a global perspective. And so, Brazil and China are key economies, and there's some really interesting developments happening around sustainable finance in both contexts. So they're included in that global assessment. There's 11 key geographies, but it's definitely an area where I've certainly seen other players kind of noting the importance of this. There's a lot of emerging markets funds, I think, that are now starting to recognize the importance of sustainable and impact investing, and kind of merging what used to be a grant making alongside an emerging markets focus into an impact investing lens.
And I'll just pitch in very shortly as well, because from my experience at the also fund that I'm working in, it's what I've been seeing mainly is that all the development finance institutions and foundations are doing great work in the global south, trying to set up the infrastructure there to kind of get more private capital into those continents to support impact investing. So it's definitely in the works. There's a lot of activity going on, and also to help out with their development to make it more sustainable. So it's definitely a focus at the moment as well. We'll go on to our next question. This is actually coming from us. So could you talk a little bit about impact measurements? So there are several methodologies out there, and it's difficult to set a one-size-fits-all approach to measurement and management. And so how do you tackle this within your own organizations?
I'm happy to jump in on that, given I spend the majority of my time thinking about that question. So BSC is, as I said, a fund of funds, and we invest across a bunch of different asset classes. And so impact measurement is really different depending on which asset class you're talking about. So if you think about, let's say, debt, right? I mean, you might be a very small part of an investment that is just seen as repayable finance. You don't get any ownership. You don't take a seat on the board or anything like that, right? So the opportunity for you to get really detailed impact metrics is totally different than, say, early stage venture, where you're taking a significant ownership in the company and you might have a board seat or all the rest of it, right? So impact measurement from an investor perspective depends on what kind of asset class we're talking about. I think that's the first thing. The second thing is that if you want anything done well, it has to be of value to the investee, right? And that's the same for impact measurement. So the difficulty, the tension that you have is in measuring stuff that would be great to know the answer to, or that allows you to very neatly align it with like the SDGs or the IRIS Plus metrics or whatever, and so balancing that with something that's valuable to the founders or the investee or whoever. So that's another challenge, and again, that depends different, depending on the asset class where you're at. In early stage venture, the key thing is just to get to a product market fit, and so you have to find a way for impact measurement to be relevant to a founder who's trying to create product market fit. I mean, if we went to Tom and we said, Tom, listen, day one, we want to know what your impact KPIs are going to be. Tom's going to say, I'm trying to figure out my product here. Go away. Let me think. Right. So it's a conversation that comes in much later on in the journey. So I guess what I'm trying to say, long story short, is that there's no one size fits all. You have to take something bespoke and think about all the contextual variables in that and come up with something that sort of works for everyone. And it's definitely not we're still iterating. We haven't landed on the best way of doing that. But yeah, it's a hot space. So I don't know, watch this space. We'll see what we come up with.
Yeah, I wish someone would figure it out so we could all just use it, right? Yeah, I mean, there's two layers to us. There's our investments that we make, and there's us as a company, basically. So the investments we make, reporting impact is probably done on a company by company basis, then trying to roll some of that data up to give our users of the app like an aggregate view of their impact. And we use some of the frameworks that Nicholas mentioned as much as we can, and we do as best as we can with the data that we have available with it. But I think the quality of the data, the availability of the data is getting much better. We started to build our own impact data and impact specialist kind of team internally so that we can do that better as we scale. And then us as a business, yeah, we don't. It's as a startup ourselves, I think there's a few KPIs that we can track, like the make of our customer base is one of the financial inclusion KPIs we can talk about. How much we've invested, how much carbon we've offset, what is the impact of the behavior changes we've managed to get people to do on the expenditure. Those are the kind of things that we think about as a business.
And so, as I said, we don't do the investing side, but just to maybe add on to a couple of things there. I think one is that we've supported the impact management project, which I think, Nicholas, as you mentioned, the challenge of trying to get the right fit is really difficult, but there's an added layer of difficulty when every investor is asking for something slightly different, and it's never the thing that the company wants to be tracking, or it's irrelevant, or it doesn't match. And so their work is really detailed, deep work across all the different organizations that are kind of, data providers and GIN and all the others, and also working directly with investors to try to get at least some principles agreed, so that there's a broad framework for what people are asking for, what's being provided, and there's some kind of harmony brought to what I think a few years ago was a particularly chaotic space, and is starting to get a little bit better. I think the other thing I would note is some interesting developments, particularly when you get to, because I think if you're investing in small organizations, so you're going to find it easier to kind of get the particular data that you need. But when it comes to public equities portfolios, and you're trying to think about impact, it's going to be very difficult. And organizations like CDP that people are reporting to make that easier. But I think the shift we're seeing now to asset level data and satellite data, particularly with climate, is what I'm talking about, starts to bring it into the space of, you could maybe verify what people are reporting and hold companies to account for the statements that they're making, or the methane leakage from their gas, whatever. And I think that's a really exciting trend that we'll start to see much better data and verifiable data over the next few years.
And our next question is, what asset classes does tickr bring to retail investors, and how does that relate to impact goals?
So at the moment, it's mainly listed equities and listed fixed income instruments. Eventually, when we're a bit bigger, we'll do probably some non-listed stuff. Fully aware that there's deeper impact in non-listed than there is listed. The reason for us starting with listed is, if you think about our customer base and the problem that we're trying to solve on the way in, we have to have liquid instruments for retail investors who are first-time investors. So we have to aspire to have as much impact as we possibly can in listed markets with equity and fixed income, which is limited versus privates. And then as we get bigger, and we can offer more complex, in the regulator's eyes, financial products, so we can go into different areas. So yeah, that's the current offering. And the second part of the question, how's it related to the goals?
The impact goals.
I'm not sure I understand what that question means.
Yeah, I think you gave a good answer.
Yeah, perfect.
So we'll give you a pass. Okay, and I guess this is a question to all of you again. Do you believe that impact enhances financial due diligence, or that it promotes negligence with respect to underlying financial fundamentals? It's a big question.
I think it enhances it, personally. It definitely was, in the way that in the teams that I used to work on and how we think about it at tickr, it's like it's an additional layer. So therefore, you're doing all the core normal stuff that you would do, all the fundamental financial stuff, and then you're doing all this DD on impact. So that can only be an enhancement, really. It's only be like an additional step that you would take. So I've never worked in a team or seen any impact investor, glossing over the former, the financial element. It's always been done in addition to. That's my experience anyway.
And Nick, you argue that there's a strong case for impact emerging in early stage venture investing. Do you think this captures the totality of impact value? And if not, where do you think the next growth center for impact investing will be?
When you say the totality of value, you mean from a growth of impact investing perspective? Like what is the main driver of, yeah, got it. Well, so in times of crises, venture always does really, really well because there's lots of new opportunities that the crisis has brought about. There's lots of labor, and there's lots of desire to bring those things together, right? So we saw a lot of stuff Uber, for example, coming out of the last financial crisis, and I have no doubt that there'll be a bunch of stuff in venture. So venture as an asset class will be growing, and it's also like thinking about build back better and all that stuff. It's also becoming more and more concerned with impact. So those two trends combining mean that's going to drive a lot of the growth in impact investing. Having said that, venture tends to be quite small ticket sizes compared to some of the other stuff. So by default, it can't be a huge size of the pie. I think where we will see much bigger drives there is in like big ticket items like infra, for example, infrastructure projects. I think it was BlackRock, although don't quote me on that. I think last year they raised an impact investing fund. I think it was 500 million, I want to say, with 100 million first loss capital to do green infrastructure in emerging markets. So that kind of stuff is more familiar to the big players. It's sort of safer-ish, and so that will be driving a huge part of it. Linked to that, we've seen, particularly throughout the crisis, we've seen stuff with government-backed revenue models do really well because governments have paid out through the crisis to keep the economy going. And so we think that things like affordable housing, social outcome contracts, or development impact bonds, as they're called in emerging markets, where the government is the underlying source of revenue for those instruments, that stuff will really pick up because it's an excellent diversifier against the market, right? So we've already had a number of conversations with people who are interested to understand that space more. So I think you'll probably see some of those big ticket items that tend to be more well understood, like infra, that'll be driving it, as well as stuff that we've recently learned is interesting from an investment perspective, like government-backed revenue. I think those things will be driving impact investing more broadly moving forward.
No. And we have time for one last question, and I'll pose this to all of our panelists. So financial segments rarely have linear growth. What do you think are potential hurdles for future growth in impact investing? How can we address these proactively?
I can jump in on, I think I listed a few of these as kind of what we're looking at. I think from our perspective, and particularly focused on trying to grow the kind of impact lens of the mainstream, there's the legal and regulatory sector, there's the kind of voice of the beneficiary, so having pension savers and individual investors kind of making their case. And so I'm sure platforms like tickr are an excellent way of doing that, but a barrier will be if those voices aren't heard. And then I think the investable universe of options, so making sure all of that is linked up and that there is a real drive for real economy shifts in favor of net zero, in favor of fairer economies, and in favor of social outcomes, and a recognition of the kind of financial benefit to the system of doing those things.
Cool. Mine is not really like a problem with the impact investing itself, but I think the impediment to the growth of proper investing is misperceptions around what investing actually is. I think a lot of people who have come into investing in the past 12 months thinks it's buying and selling Ethereum like hour to hour, and I think that could impede other forms of investing growing, like impact investing, basically sustainable wealth creation over the long term by investing in companies that are doing good stuff for the world. So I think the onus is on us to educate and try and cut through with some proper messaging, because I think that other form of investing is very, very damaging, and it could result in people not coming back to the industry having had bad experiences. So I think that's something that we need to overcome.
And yeah, okay. I think that brings us to the end of our panel. Thank you so much to our panelists who gave great insights and for your time. And before our next event, which is at 4 p.m., we'll take a small break and see you for Beyond Environmental and Social Disclosure. Thank you so much.
Thanks, Ram. Cheers.
Thanks, everyone.